This is Robert Thompson again, and I'm bringing you another 2-minute segment on the things that a bank looks for when they are determining whether or not to issue you a real estate loan. And I've broken it down into 4 things, 4 C's. Okay, the 4 C's are, and we've done the first 3 already, so you can go back and watch those videos if you haven't already seen them. The first one's credit, your credit score, your credit history. The second one was collateral, the house that you're buying, and making sure that the bank is comfortable with how much it appraises for. The third one was capacity, your capacity to repay the loan. And the fourth one is your capital. Now, to be clear, when I say your capital, I don't mean Washington, D.C. What I do mean is your money. So it's broken down into kind of 2 halves here. The first half, which does sometimes apply and does not sometimes apply to loans, is your reserves. How much money you've got sitting in the bank. Some loans require you to have a certain amount of money sitting in the bank in case you, for example, lose your job. They feel secure in knowing that you've got some backup money to be able to pay them their monthly mortgage payment. Now, that, like I say, may or may not exist on a loan. Some loans have it, some loans don't. Now, the second thing, and the more universal thing that is on all loans, is how much money you're putting into the transaction, so your down payment. Now, all else being equal, if you have a 5% down payment versus a 20% down payment, your interest rate's going to be lower on the 20% down payment. The reason for this is because they know, just by sheer force of having studied this over many years, that the more money you put down, the less likely you are to default on your loan. And the less likely you are to default on your loan, the happier the bank is, and the happier the bank is, the lower the interest rate becomes. So, you know, the riskier you get, if your credit score goes down and you don't have any money and your debt to income ratios are very high, well, they're going to give you a worse interest rate. So that's how that all fits together. So that is the final C in a nutshell, capital. So credit, collateral, capital, and capacity to repay. I hope this was helpful. I hope the other videos were helpful. If you haven't seen them, go back and watch them, and I will talk to you soon. Adios. Thanks.